morning, everyone. Welcome to our program. I'm Margaret Mueller. I'm the president and CEO of Exec Club. Thank you for joining us for this quick program we pulled together on what do bank failures mean for your business. I'm joined by a fabulous panel. We're really excited to welcome these speakers and learn from their expertise. So joining me today are Tom Califano, partner and restructuring lead at Sidley, Tim Crane, president of Wintrust, Sonia Nagar, general partner, Pritzker Group Venture Capital, and Martin Wellington, partner of emerging companies in venture capital and Palo Alto office managing partner of Sidley. Thank you all for making the time to share your viewpoints with our audience. I'm sure you have nothing else going on right now. Your lives are quite quiet and you had all the time in the world for this, but we really appreciate you being here. So because we have lawyers on the panel and this is a big topic, naturally, I'll have to start with a quick disclaimer. So the panelists' views are their own. None of this is legal advice. You should be sure to consult your own advisors before taking any action. And the situation is changing not daily, but on an hourly basis. And so be sure to watch for ongoing developments. And for those who are watching the recording of this, I want to note that we're recording this at 10 in the morning in Chicago on March 15th. So depending on when you're watching it, some things may have changed. So that's it for housekeeping. Let's jump in. As I said, my questions keep changing too. When we pulled this together on Sunday or Monday, I had different questions. And then yesterday, I had different questions. And today, I have even more questions. And so at this point, I know that everyone basically understands what happened, but I do want all of your analyses on it because as we learn more, our perspectives change and we want to focus on what comes next and especially for Chicago. So I'm going to start with the Sidley folks. And Martin, I want to start with you. What is the vibe in Palo Alto right now?
Thanks, Margaret, and thanks for having us. I'd say the overwhelming vibe here is relief at this point. With the actions that were taken by FDIC and the government to put the two banks into the bridge bank arrangement and continue business as usual has meant that we went from the obvious the initial days of this where it was just a lot of uncertainty and people really not knowing what to expect to a weekend of not knowing whether we could make payroll or we could, get bank, financing for things we needed. Now we know we're back to business as usual. There's still some glitchiness in the system and whatnot, but the people are able to get to access to their funds. People are making payroll, and I think that so as I say, overwhelming sense of relief. I think. Mingled with that is an acknowledgement that one of the institutions of Silicon Valley, really of this community, nationally, failed, and cognizant of what that means, and really, the sobering realization that one of our institutions has fallen, and that's lost on no one. But I think those are really the two principal sentiments in the Valley right now.
Yeah. So I know that everyone knows basically what happened, but my question is, how did this happen so fast, or did it? Did you kind of see it coming for a while? Because to those of us who aren't in industry, it felt like it happened really fast.
It happened very fast. And I think that's evidenced by the fact that the bank was closed at 11:30 in the AM on Friday. And they never close a bank in the middle of the business day. That creates a problem with wires, transfers, et cetera.
Right.
So the reason why is because the deposits kept accelerating. Okay. And it was a victim of technology. Okay. It was a victim of, it's like the first bank that failed because of Twitter. But it happened extremely fast. And the catalyst was, I think, much faster than people were able to react. The catalyst for people withdrawing their deposits.
Yeah,
well, I think too this is one of the strengths of the Valley and the technology and emerging company sector generally is the relationships, but it also means that people are really hyper connected. So whether it was Twitter or where it went, I mean, there was when the word started to go out, everybody has their networks, and it whether it was online on Twitter or it was going around, sort of personal, contacts and whatnot. It's just a very, very, very connected community, which has always been a strength of the Valley, but and really this community nationally. But it in this case, was a propagation vector.
And so, Tom, you're talking to us from New York. I'll ask you the same question. How's New York feeling?
Well, I don't know how they're feeling, but I think people were focused on the opportunities that presented, and that changed, as things developed and as the government made and the FDIC made more pronouncements. This weekend, people were saying, is there an opportunity to provide bridge loans? Is there an opportunity to provide financing for those very firms that Martin mentioned that may miss payroll? Okay, that changed when the FDIC announced that they were going to create a bridge bank and that business would continue as usual. Now people were looking at whether there were assets for sale or that opportunity. Well, now it looks like it's not going to be an immediate liquidation of those banks. It's operation. And now people are looking at, the opportunities presented by what everybody anticipates to be a holdco bankruptcy filing imminently.
Tom, remind us, what was the last major bank to fail, and how are these few similar or different to that?
I looked at it, and it depends on what your definition of major is, but probably there hasn't been. This is the second largest bank failure. SVB is the second largest bank failure ever, right? So this is the largest concentration of uninsured deposits. I think there was about 109 billion, but there hasn't been a real significant bank failure since probably 2010. Okay, and there will be the fallout, I think, will be a little different here, and because there you have Dodd-Frank, which went into effect mostly after the last failure. You had some changes in the law, you've had changes in operation, so that'll be different. The other thing is, this was a very, even though it happened and because of technology and people's communication, this is like an old-fashioned run on the bank, right? Silicon Valley Bank didn't have balance sheet issues. It was a run on the bank that just accelerated and accelerated. So in a lot of ways, it's different than the global financial crisis, but more akin to early bank failures on bank runs. So.
Yeah. And Martin was sharing that for the customers of the bank, it feels, and folks in Silicon Valley, it feels like business as usual. From the banking perspective, is it business as usual? Is there a lot more that's going to happen?
Tim Van Handel, I mean, the FDIC, as I said, keeps making pronouncements that business will be conducted as usual, that the bridge banks will honor their obligations, and importantly, that they expect third parties to honor their obligations to the bridge bank. So I think to the extent possible, they intend to have business as usual. Of course, there may be glitches, starting up so quickly and with the quick turnaround, but I think it's expected that it is business as usual.
So what happens to the parent or the holding company of the bank and the other affiliates? So yes, there's the bridge bank that's helping serve the customers, but what happens to everything else?
Okay, so the banks can't file Chapter 11, right? A failed bank is administered through the FDIC's receivership system or receivership scheme, but holding companies can file bankruptcy. I was deeply involved in probably the largest holding company bankruptcy, Washington Mutual, back in 2008. So typically there is, there's issues as to which assets belong at the bank and which assets belong at the holdco and administered. And then, Silicon Valley Bank and Silicon Valley, the holdco, the parent, had significant creditors of its own. So what will happen in this Chapter 11 case is there will be a sorting out of, which bucket those assets belong, either the receivership bucket or the holdco bucket. You've got significant non-bank assets here that can be administered and sold. And then you're going to have receivership claims made against the holdco.
So you're not done.
Well, I think there's a lot, that still needs to play out. legally before we see where, where all the dust.
So I'll ask all of you then, what additional reverberations or consequences for this are you looking for or watching for? What else could be happening that maybe won't be so obvious to those listening?
I can start quickly, I guess, from the industry sector, the customers, as it were. I mean, I think this model grew up over many years and has proven itself to be a really powerful support to all of the innovation and entrepreneurship that people think of in tech and life sciences and not just here but nationally. And there are fundamentally different things when you're lending to companies that are at very early stage, right, that don't have cash flows to service the debt, that have a longer pipeline to getting to to maturity and all that. I mean, there's a lot to this model that actually makes a lot of sense. And I think that now that Silicon Valley Bank is back up and lending and doing the things that it was doing, there's near-term relief. But I think that the longer-term question is, with every crisis, we've seen a wave of regulation and a wave of response as people trying to figure out, well, how can we avoid this next time? And of course, that's totally appropriate, right? We want to make sure that this doesn't happen again, and how can people be better prepared for it? At the same time, there's a lot of value, there's a lot of good in this model over time. And as Tom said, this was not a structural issue with the bank. This was not, this was a run on the bank, really, at a fundamental level. And I think that at least what I'm looking at for, and I think people are looking out for here is, hopefully that the response is proportionate and doesn't go too far and undermine what has really been an important pillar of supporting entrepreneurship.
Any other potential fallout that you are watching for, any of you, that may not be so obvious to people?
Margaret, I can chime in. I think, obviously the media is asking whether this will change the Fed's approach to managing interest rates. Inflation's been a big part of the equation, and so folks are wondering whether interest rate increases will slow or stop as a result of this.
What do you think?
Yeah, I think they're unrelated, frankly. I mean, what's happened with the banks, and we can talk in a second about that, but inflation's still a big issue and in many ways a pervasive issue for the same companies that are affected by these bank failures. So I think the Fed's going to continue working to drive inflation down.
So let's turn our focus to Chicago, Tim, and I do want to turn to you. So as the leader of a Chicago headquartered bank, what makes a bank like Wintrust different from another like regional bank like Silicon Valley Bank or Signature Bank New York? And I want to make sure it's clear to everyone in the audience. Signature Bank New York, we have a Signature Bank here in Chicago. They are not in any way related. And so to our good friends over at Signature Bank in Chicago, I want to let you know that, we're going to do our best to avoid any confusion. I'm sure it's been very challenging for them. But just setting that aside. So, you're a very large regional bank, but different. So help us understand what's different.
Sure. Well, one of the questions we get is, did we see this coming? And the answer was no, in terms of a bank failure. But as interest rates have risen very, very rapidly, there certainly was stress in areas where you could predict something would break. And not everybody kind of knew what that was going to be. But in this case, you had a financial institution with a very concentrated deposit base with companies that depend on continuing to raise money. And that was getting more and more difficult as the past few months passed. And so the two things that I think are different at Wintrust and that many other banks would say are different as well is, one, we were very well positioned and continue to be well positioned for rising interest rates. And if you're not, that becomes problematic in terms of your ability to maintain appropriate capital levels and to serve your depositors. The other is that we have very few concentrations. Both as a bank, we focus on making sure that we serve a diverse population. And the Chicago economy is very diverse, different types of companies, certainly different types of activities. And frankly, it's very healthy.
I know we do talk that often as one of our biggest strengths in Chicago is the diversity, right. And it seems like that's proving out in times like this.
Right.
Is there anything specifically that you saw in Chicago, either for Wintrust or just in the banking community in Chicago, differently these last few days than what was being experienced on the coasts?
Well, we certainly didn't, compared to the West Coast, have the immediate issue of the bank failures. And so our challenge has been more around communication and making sure that folks that have been spooked by what's happened understand what's real and what's not real. Certainly the general media has spent a lot of time on this, certainly the business media. And so we've been communicating with customers and just telling the story. And by and large, I think the story in Chicago and certainly at Wintrust is a good one.
Yeah. Sonia, I want to ask you, how is the Chicago VC and tech community feeling?
So it's been a crazy 7 days. I think Silicon Valley Bank has been a pillar of the community for so long. Funds were depositors, our companies were depositors. For Pritzker Group, about 20% of our portfolio in numbers were impacted by SVB because they were depositors, but that actually doesn't tell the full story, because some of our largest and most valuable companies, for any company that hits a certain scale, they tend to take on some venture debt. And Silicon Valley Bank was the lender of choice. They were always the most founder friendly, provided the best terms. When our founders had choice, we often advised them to take Silicon Valley Bank because of their long history of being in this space and their supportive nature when it came to working with startups. And so as a result, and then when you take on debt with Silicon Valley Bank, one of their terms is typically you need to hold a certain bank balance. So while only 20% of our overall portfolio was impacted, the dollar value, our most valuable companies were almost all of them had accounts with Silicon Valley Bank. And so starting on Thursday morning, things got a little bit wild. We had some companies that were able to take money out, others that weren't. There was a lot of activity over the weekend to make sure that our companies were shored up. We're fortunate we're a fairly large fund, and especially for some of our largest and best companies, they have large syndicates with other deep-pocketed investors. So it was easy to put bridge loans in place, but it was a lot of work. And then I echo Martin's sentiment. Starting on Sunday night, there was a collective sigh of relief, but still there is some uncertainty around how the working capital loans are going to be handled. There's still a lot of things that have to shake out. And then there's a flight. There's a big, almost every board call that I had Sunday, Monday was around risk mitigation and treasury management. So going forward, that's something that we are going to be paying attention to with our companies, is where their bank balances are being held. There are a lot of folks that are moving their funds away from regional banks into the big three banks. And so there's definitely still a lot of fallout that's happening this week as people set up new bank accounts, new payroll systems. I mean, as a founder and an operator, there is a lot of intertwined systems that are connected, that were connected to Silicon Valley Bank.
Right. And Tim talked about one of the greatest strengths of Chicago is the diversity not being so tied to a single sector. And so I'm going to ask you, and then I'll ask Martin to chime in too. Help us put into context how much what happened at Silicon Valley Bank is related to other challenges the tech sector has been facing. Because I mean, tech has been facing a lot of challenges lately, and how, just put it in context, how related or not related are these?
My take is that it feels like a lot of Silicon Valley Bank, while yes, they were concentrated in the tech sector, it feels like the original sin was in 2021. A very big bet was placed in bonds at low interest rates. And then when interest rates moved, that would have killed any bank, whether it was, now I think Martin made the point about how interconnected tech is. I think if there had been more diversification, you may not have seen the speed of the collapse happen, and maybe there wouldn't have been the echo chamber of, I think on Thursday, there were certain very large, very prominent venture capital funds that were putting in calls to their founders, telling them that they needed to move their funds. And that created panic in the bank run. And, if there was more diversification, I don't think that would have happened as fast. It might have still happened, but it definitely wouldn't have happened as fast. But I think that I actually separate the two things. And I don't think they're as interconnected.
Tim, I see you maybe wanting to say something.
Well, I think one of the unique circumstances here, much like the Pritzker enterprise, and there are others that invest in many of these operating companies, and when the challenges surfaced, the call was to basically fix it across the whole population of operating companies. And so this was a lot happening at the same time. It wasn't one company at a time. It was really an entire industry, as Martin pointed out, very well connected, trying to solve a problem. And so I think that's a little bit unique that you typically don't see. In the crypto banks, we haven't talked really much about Signature, sort of the same situation in the crypto world.
Yeah, that was going to be my next question. Literally, you're reading my next question. So similar question for Signature and Silvergate and crypto. How much were their closures related to challenges in the crypto industry?
Well, I think a lot. Again, it's a concentrated industry with large deposits, typically much larger deposits than an average bank would have. And so when they start to move, it matters. And so in the crypto world is certainly getting a lot of attention these days, for all sorts of reasons. So.
Yeah, I mean, banks rely on confidence. So if you're known for being in, heavily involved in an industry that's under attack, people are going to lose confidence in you. And the banks, every bank relies on the confidence of its depositors to a large extent. So tied to an industry that's in trouble, and the crypto issues are well known, that's going to cause problems, and that's going to erode confidence in your institution.
If I could just comment, I think I agree with Tim and Tom that crypto obviously is where it is as a market, and I'm sure that that had something to do with the mindset. But I fundamentally agree with Sonia that I think that what happened here is really kind of unrelated to kind of overall sectoral trends in technology and the entrepreneurial community more broadly. I do want to just come back to another thing that Sonia said, which I think is really important. There've been a lot of sound bites about the concentration of banking relationships and the fact that all of the accounts are with Silicon Valley Bank and all those sorts of things. I mean, until recently, that was a feature, not a bug, right? In the sense that, you got the favorable banking relationship in part because the deposits were all with Silicon Valley Bank, and they were able to put that money to work the way banks do, and it made sense, and it made a lot of sense, until you found yourself in a situation where you were trying to make payroll funding on Monday and you didn't have money in any other bank account. And I think that's one of the things that, as you think about what's going to happen going forward, that's one of those issues that I think is going to have to be thought about in terms of how the sector is organized. But again, does that mean that you create new structures or make new rules that fundamentally upend the model? I think that hopefully it's a more measured response than that, and we have a chance once the dust settles to really be thoughtful.
I actually saw a really interesting new structure come forward that one of our companies uncovered on Monday. Founders are very resourceful, where it was a regional bank that created a network of regional banks that was going to be able to offer up to 25 million in FDIC insurance by automatically splitting your 250K checks amongst like 100 banks. That would be what the math would imply. But have not further explored it, but I do think this will be a focal area for founders as they think about where to put their large accounts after they get a $50 million, dollar fundraise done.
I'm going to ask a question in just a minute related to that. Are you going to have to split up the $250,000? Does it even matter anymore? But we'll get to that in just a second. And the precursor question to that is the word bailout has become so highly contentious these last few days. And so I'm going to ask each of you to give your own answer. Sonia, I'll start with you. Is this a bailout?
So I feel like bailout has a negative connotation because of 2008, when the world felt like the rich got richer and the people who made the mistakes were not penalized and they benefited from the bailout. Here, that's not the case. I think startups, these are small businesses, and even when they become large, they are job creators. And the number one line item and that you're in your P&L where you're spending your money as a startup is employment in your payroll. And so, I mean, this bailout is saving jobs, it's saving companies that create jobs, and it's saving small businesses and innovation. It's very different. The people who made the decisions at Silicon Valley Bank, the equity holders are out here for Silicon Valley Bank. So while technically, yes, people are being helped and the companies were saved and bailed out, the people who made the bad decisions were not helped, and a whole bunch of businesses were helped. And I think that's the right decision for many reasons.
Martin, what about you?
I'm not sure I could say it any better than Sonia just said it. I think this is about payroll. It's about families. It's about not, derailing an entire sector. And importantly, the equity holders, are not getting anything out of this, right? I mean, this is about intervening in a way so that something that happened in the banking community did not upend a really, really important, value creation driver in the national economy. And I think that, the word bail, look, I get it. It's a great soundbite. I don't buy it.
Tom?
I'd like to play devil's advocate and both respectfully disagree with Sonia and Martin, because when you think about it, this was caused by people pulling their deposits. The very people who started that run were, at least you said, Sonia, it's VC, it was VC funds telling their, companies to pull their funds. Well, those are the people who caused it, and they're the ones who are getting, who are getting taken care of through the removal of the limitation of 250,000. I don't think it's a bailout for one reason. It's not coming from the government. It's coming from an assessment on the banks that are in the insurance program. So really, Tim's paying for it, and Tim and his institution are paying for it, which will be passed down somehow. But I think that the more fundamental issue is, should we get rid of that $250,000 cap and just have a risk-adjusted premium? So you look at a bank, and if they've got a concentration of really big deposits, like Silicon Valley Bank had 109 billion in uninsured deposits, well, maybe they should pay a higher, insurance rate than Tim's Bank, which is much better managed and much more conservative. So, I mean, I think that's the bigger question, but I disagree respectfully, Martin and Sonia, with your take on it. I think there's a take sort of in the middle, but.
And Tim, I saved you for last, intentionally, exactly for this question. So, President Biden says taxpayers aren't paying for this. Someone's paying for it. You are possibly, a little bit. So what is your perspective on all of this?
Well, Margaret, you are too. And Tom was correct. I mean, this essentially comes out of the FDIC insurance fund, and banks pay into that fund. It's essentially not government money that's going to bail out the depositors here. Obviously, the investors will get wiped out. But every bank in the country, based on their health, pays into the FDIC insurance fund. And that's used to cover losses that might stem from bank failures. I think important to know, since 2001, there have been well over 400 bank failures. Most of them never hit the radar, a great majority of those between 2008 and 2010. And only in one circumstance did depositors ever lose any money. And so this is not, what's happened is not necessarily atypical, but it's paid for by the industry and then ultimately by the depositors, that bear some of those costs.
Right. So we are ultimately paying for it.
Yes, and to Sonia's point, there are products, and just a 5-second Wintrust plug. We're uniquely structured with 15 banks, and so customers that come to us can get $3.75 million worth of FDIC insurance versus the $250. And to her point, there are also products on sort of a shared basis where you can get much higher levels of FDIC insurance through a single financial institution.
Yeah. I know a lot of Chicagoans are wondering, what does this mean for my bank? We touched a little bit on the strengths of Wintrust and other banks being more diversified. Is Chicago generally more insulated against something like this happening?
Well, yes and no. There's a rational part of this and an irrational part of it. The rational part is how healthy is your bank? And certainly banks have been managed and positioned differently for rising interest rates. Both of the banks that failed basically had declining levels of profitability. because they were hurt when interest rates went up. Many banks, Wintrust included, are helped when interest rates go up. That's a choice the bank management makes. So I think most banks were well positioned. So the minority of banks would be hurt. But there's irrational part of this is when people get spooked, strange things happen. And large demands on deposits can be challenging. So people should understand what their bank looks like from a financial health standpoint. Certainly if they have more than $250,000 there. And realistically, for most businesses, that's the case. That they most frequently would have that much money there to make payroll or to buy goods. So it's worth asking some questions.
I'm going to ask all of you, would this have happened if we didn't have social media?
Yeah,
I know you can't predict, but what do you think?
Well, I think it's a great question, and I think it would have been much less likely. The availability of information certainly speeds these events. In many cases, it helps solve them quickly too, but certainly what happened had an element of networking attached to it, I think.
We're probably.
I would say, actually, I'd say, I think, Tim, I agree in some respect, and I disagree in another, which is to say that, social media is a relatively recent phenomenon, in the overall arc of things. The relationships that are the foundation of this community is not. And, and the telephone has been around for a very long time. And people talk to each other. And so I think I think certainly there's no question that social media accelerated what happened. And maybe there would have been more time to respond or figure out a different way, to divert it, because it happened so quickly. There really wasn't an opportunity to divert. But the spread of information, I think would have happened very, very quickly. Maybe not quite as quickly, but still very quickly through the relationship network that has been the foundation of this community for half a century.
Yeah, I agree. I think part of the information flow was email, text, not necessarily all social media driven, because there are a lot of private conversations and private networks. And so I don't know that the tip of the spear for this one was social media. I think it was more private founder networks and portfolios for venture capital funds that were getting the call.
Do you think social media contributed to the decision to cover all deposits over 250,000?
Listen, my speculation is that the reason I decided to cover all deposits was because they were afraid that Monday morning you'd have a number of other bank failures.
Mm-hmm.
So it was going to compound the problem because, people were pulling, people were trying to pull their deposits, and, there was like that speculation ran. So I think that it was a decision. Listen, I wasn't involved. I had no idea. Nobody consulted me, but I think the decision was, if we don't do this, we're going to be facing half a dozen failures that'll continue to spread. So let's bite the bullet on this one and sort of staunch the bleeding. That's my speculation.
Yeah, but does this set a dangerous precedent? Like, what are people expecting now going forward? I know there's been a few. This isn't sustainable, over several more. But what do you think people are going to expect?
Well, I don't know what people expect, but I thought the solution would be to change, get rid of the limit and change the way you calculate the insurance. I don't know. What do you think of that, Tim? You're a banker who has to.
Yeah, well, I mean, to be clear, there's explicit guarantee for these two banks, the depositors of these two banks. The implicit message has been, we're going to support the banking system, and depositors should not be concerned, about their deposits. But those are two different animals. I think there will be a pretty hard look at how FDIC insurance is handled and the like. I mean, $250,000 is a relatively small amount for many commercial enterprises. It's a lot for individuals, but it's a little bit of a challenge.
So Tim, you said you've been spending a lot of time reassuring customers and just confidence and trust. What are the things that you're focused on? Or maybe another version of that question is, what are some of the misconceptions or fears that you're hearing that you most strongly are trying to address?
Well, the general media kind of covers this with a broad brush. And so you don't always get kind of what are the real questions that I should be asking. But was your bank or is your bank positioned for rising interest rates in this environment? Are they well capitalized? If they had stress situations, do they have the right mechanisms in place to address those? And we're very conservative. We've tried to describe to our clients why they should feel comfortable with Wintrust. I think other banks are doing that as well. But it's been a lot about education and a lot about communication. Most of it I wish they never had to deal with, frankly.
Right. I'm hearing a lot of concern that banks are going to pull back on loans. Is that something that you're anticipating?
I think there are normal adjustments in the market more related to rising interest rates than relating to this issue. Certainly, if you're a real estate developer, what worked at 3% doesn't work as well at 6 or 7 or 8%. And so I don't think it's a related event, but I think you are seeing market dynamics adjust to higher interest rates.
Yeah. Tom, were you going to say something?
Yeah, I was just going to say, I think before all this, the credit markets were tightening. At least I'm seeing that from what, my role as a restructuring lawyer,
Right.
and I think there's always, anything like this, there's always an overreaction, not just a reaction. So could there be an overreaction and, people shy away from loans that, people could think are more problematic, more speculative? I think the market was going there anyway. And I think the overall lending climate, at least I'm seeing it, for the deals I'm working on, was getting tighter, even long before any of this stuff came out.
Yeah, I think it's important though, just saying, Sonia, I think you'd probably echo this maybe, or disagree with me if you want, but one thing that has been in the press is that there's just not availability of capital today, right? And that's just not true. I mean, the banks are actually lending. I mean, deals are getting funded, calls are getting funded. It is business as usual, and I think it's important that people understand that those revolvers and whatnot that are in place today are being honored, and so that the companies do have access to capital and the full panoply of services that they had available. Again, maybe with some glitches and whatnot, but Silicon Valley Bank is open for business, obviously under new management, as it were.
Sonia, I was going to ask you, are your portfolio companies concerned about access to capital?
Tom made the point that things had changed about a year ago. So in 2022, things started to get a little bit tighter, more correlated with interest rates rising. And I think compared to 2021. So in 2021, it was an unusual year in that there was a lot of money that flowed into venture capital and out into companies that created a very competitive environment that drove up prices. And things have now corrected back to maybe normal times. Like, I don't think that we're in an abnormally low funding environment, but so startups are always worried about access to capital. We at Pritzker Group, we have a very large portfolio. We've been investing for 30 years. And so we have everybody from early stage, seed stage companies to pre-IPO companies. And I think the folks that are most concerned are the pre-IPO companies, because the IPO market, that later stage market has gotten really tight. Valuations have come down with the stock market, because that's, where people are looking to get their comparables for valuations. And a lot of those later stage funds paid too much money and maybe didn't make, the best valuation decisions in the last couple of years, and are no longer investing or have slowed down their pace of investing pretty greatly. So the biggest concern is at the later stages. Early stages are business as usual. A lot of money has come into venture funds, and that still has to go out. And so I'd say from seed to Series B is relatively insulated. Series B and beyond is where those companies are a little bit worried, but the best companies are still getting funded, deals are getting done. The valuations are just, I would say, more rational than they have been over the last 2 years. But it's very much business as usual.
Is there anything the Chicago VC or tech community is going to start doing differently?
We're looking at bank accounts now. I mean, we definitely are interested.
Tim's open for business.
We're open.
Business. We're looking for unique products to give greater coverage, and we're looking for diversification. I mean, I think, you don't want a single point of failure. Institutional trust is probably at an all-time low, or trust in institutions, I should say. But yeah, that's probably the most material immediate change. And then we're trying to figure out, on the lending side, I think interest in debt had chilled more based on interest rates and the cost of debt, but we're paying attention to see who's going to try to hopefully fill Silicon Valley Bank's shoes. And maybe that's SVB. I know they're in talks with potential acquirers who are reaching out to venture capital funds to, try to get support for people to put money, I guess, back in, because almost all of our companies that had deposits with SVB have pulled. Like, I can't name a single company in our portfolio that was had a deposit at SVB that has not pulled their money out of SVB as of today.
Wow. And that in your one fund. So imagine.
Yeah,
Right.
But I think the sentiment is shared that there's no reason to have to deal with any level of uncertainty. And so
Right.
Why would you?
Why? Well, Martin, why would you? Because you did make the case why it is critical to have this ecosystem. Do we need a Silicon Valley Bank now that VC has matured? I mean, they were so critical and were the only ones that would lend to these startups, right? Like 25, 30 years ago. I mean, but now in the stage of maturity, something like an SVB.
I think, I guess I would say that point of view takes the idea that the sector itself is a unitary actor. And in fact, I think the unit economics are at the company level, meaning that, Sonia is still out there investing in seed stage Series A, and those companies are still, pre-revenue. They're doing deep R&D. They're developing, they're trying to test out and prove out the business case. They're going out with, beta testing. I mean, those companies still need access to venture capital, and they still need the security blanket of knowing that they've got, lending available to extend runway in difficult situations or something comes up. And they still need, a partner that understands all of those dynamics within the venture community in order to fuel innovation and value creation that we've seen and come to expect out of the sector. So I think that, I do think it's an important part of the economy, and I do think that it's going to continue to exist, albeit with, certainly some soul searching around some of the things that Sonia and Tim and Tom have been talking about. But I think that this is, continues to be a critical part of the economy, and I expect it to continue to be available.
Tim, are banks, more traditional banks like Wintrust, are they set up to serve this community the way that Sonia and her peers need them to be served?
Generally, yes. And we certainly have a number of companies that would consider themselves technology companies or life sciences companies, or even early stage companies. It's, again, not our specialty necessarily, and we've got a broader set of offerings. But a lot of the banking piece of the equation, maybe save some specialized lending, is pretty generic. And it was really the requirement that deposits moved with the loans at Silicon Valley Bank that allowed them to grow as quickly as they did. We have all sorts of clients that maintain multiple banking relationships. In some cases, we advise them to do so.
Yeah. So speaking of doing things differently, there's been historically a contentious relationship between Silicon Valley and Washington. We've seen it play out in the media over the years. Martin, I'd want to start with you. How, if at all, do you think that relationship might change?
That's a good question. I think that those, those sort of sector issues and the relationship between this community and Washington has long roots, and there are arcs of sort of development in those issues that I think will continue. I don't, I think as we look at what happened here over the last week, the government's response is, and again, I think Sonia put this, better than all of us, that it really was an acknowledgement that this is an important sector of the community and nationally, and that the government was protecting depositors and protecting, this part of the economy, and acknowledging, implicitly the importance of that to the national economy. Tom put it well, that, the move was really about shoring up confidence in the overall banking system. I think that, these are important moves and show that there's an acknowledgement that it's not a one-dimensional us versus them sort of thing. There is value here, and I think that the way that the reaction was styled, was constructive. I think that does it affect those longer-term issues between Washington and Silicon Valley? Honestly, probably not. But I think it does show that there is, underneath all of that tension, and or a partnership, that this is an important part of the national economy.
I mean, Tom, does this finally create an environment where there will now be more regulation?
I don't think, I think every time there is a problem like this, there's more regulation. Like sometimes the regulation creates its own problems, but I think we can expect that they will try and have a regulatory or legislative, solution to what people perceived as the problem. And, what unintended consequences come from that, I don't know, but I think we can anticipate there will be a response.
Mm-hmm. Sonia, is there the same feeling in Midwest tech? Silicon Valley tech has been very vocal that, Washington doesn't understand them, can't regulate them the way that they're used to regulating industries. We know best, let us do what we need to do here. Is there that same sentiment in Midwest tech?
I feel like we're a much smaller community, and there is a uniting organization called the National Venture Capital Association, NVCA. We have an Illinois version, the IVCA, that's pretty well integrated and tries to be the conduit between the venture capital community and the private equity community and Washington. And I think they've done a good job of trying to represent our interests there. And so I don't know if this is, maybe because I've been more involved with that organization, I feel like we're more collaborative, and then we're a smaller group, and so maybe it's easier for them to touch that organization, to touch the community. So I'd like to think we're a little bit more collaborative, but ultimately it's a national issue, and so it's, it doesn't matter if Chicago's collaborative. We need everybody to hold hands here and work together to make sure that regulations don't crop up that will hinder innovation in this sector.
Right. I mean, Tim Wintrust obviously has strong governance and a strong board, and what we've learned is not all banks do. And so what are you expecting or looking for in terms of regulation and scrutiny in banking?
I think you'll get the normal, what did we miss from the regulators? And, we're engaged, I would tell you, almost hourly with examiners right now as they try to make sure that there aren't other situations like this out there. I think you'll get some different metrics that people should look at. You'll get some disclosure, and then we'll see how far that goes. But in general, having educated customers is a good idea. And so the more they ask us is fine. We're happy to answer questions.
Yeah. So I know everyone is very optimistic, and everyone hopes that this is it and we don't see anymore, and want to convey that publicly. We're all supposed to be, chief marketing officers for our industries and organizations. But I'll just ask you, what is your rate of probability that we might see another bank failure in the coming weeks?
Well, I don't know the answer to that question. I'm sure the regulators will work very hard to try to solve any of those problems before that happens. And if we get there, I think, you start the cycle over again, and it opens kind of a new wound. So I'm hopeful that we don't have that.
Yeah, I agree. I mean, this is not like 2008 or even the S&L crisis, where there was a there was a problem with the banks themselves. There isn't a problem with the bank system. Banks are well capitalized. If there is, I hope there's not another failure that's just a run on the bank that's unnecessary. Okay. But, you don't have the systemic problems that you had in the S&L crisis or in the global financial crisis. You just don't have those issues. And the banks have been better capitalized and they've been more conservative. So I'm hoping that there isn't. I'm hoping that there isn't a spread of, contagion, because I don't think there should be. If there is, it's probably unnecessary.
How do we know?
Margaret, maybe helpful, sorry to interrupt.
Yeah.
We have not seen anything unusual in terms of our activity the last couple of days. And I think my peers at most of the other Chicago banks would say the same thing. So it's at least in Chicago and among the people we talk to, it's been relatively business as usual.
But how do you know if your bank is well capitalized? So I don't think anyone necessarily knew that Silicon Valley Bank, as Sonia pointed out, was so overexposed in these long-term treasury bonds that they purchased at a time when
Right.
rates are really low. And so how would you know that your bank is not in that same situation and that they're at risk?
Well, you can ask, and now lots of folks are preparing sort of fact sheets that show the securities positions of the various banks. And so it's, if somebody had a large securities portfolio and there was certainly a lot of pressure to invest it when rates were very, very low. And if they didn't resist that pressure, you're going to be able to see it in their financial statements. And more, the analyst community and the investor community is putting out some worksheets that help you get there.
Yeah.
Yeah, I mean, I was following on Monday that trading was halted for PacWest and First Republic Bank because of the unrealized losses on their balance sheet. That is another metric that I know folks are tracking. And so you asked a question earlier, like, what is the percentage chance? It's not zero. So that would be my answer. But I hope it's, I hope it doesn't happen, because I do think that if it happens, it would be triggered by panic. I don't think there are other banks that have the information echo chamber that Silicon Valley Bank was in, and so that may limit it. But there are definitely banks that have the same issue that Silicon Valley Bank had, which is that they're overexposed. If they took too large of a position in bonds in 2021 at a time when interest rates were, it was a different environment, and interest rates have moved so quickly. It's, this is not a tech sector issue. This is a broader issue. And so their banks aren't insulated just because they're not investing in or supporting the tech ecosystem fully.
So if we all start, go ahead.
No, I was just gonna say, it's not a tech sector issue. It's a hedge issue, really. That's what it was. Hedging issue more than the tech sector issue.
100% risk management as like a function in a bank.
So am I understanding this correctly? If we all start behaving like business as usual, it will be business as usual.
Yeah.
If we start behaving differently, it'll be different. So that's the outgoing message for everyone listening. Business as usual.
Yeah.
I have one final question for all of you, but before I get to it, I just want to see if there's anything we didn't cover that you think is really important for our audience. Okay. So I'm going to ask the same final question of each of you. And Tom, I'll start with you. What is one thing that you know for certain is absolutely true right now?
One thing that's absolutely certain is that things change dramatically and change in ways you can't anticipate. So you need to be ready for disruption.
Change is the only certain thing.
Exactly.
Tim, what about you?
I've got part A and part B. Part A is, I know baseball starts in Chicago on March 30th and the Cubs are tied for first place. And I know we'll get through this, but we'll learn a lot from doing so.
Sonia?
It's a great time to be investing in technology. And I feel like some of the best companies are built in tough economic times, and it's a great time to be investing.
And Martin?
As much as I'd like to go to baseball, I'm gonna look. I mean, I've been doing this in Silicon Valley for over 25 years. It's an incredibly resilient market. There's always, the new thing, as Michael Lewis called it. This is a community and a group of entrepreneurs and value creation that is going to continue to do what it does. We've come through, two .com bust, the S&L crisis, the global financial crisis, and we're going to come through this, and it's going to continue to be strong. It's going to continue to be an engine for the economy, and and it's a good place to be.
Thank you all for being here and sharing your time. Before we wrap, I want to remind our listeners about one incredible upcoming program we have on Club's opening day. So if you're not going to be at Wrigley Field for opening day, we hope you join us at the University Club instead for a program on financial times ahead, what the current economy means for the Chicago region. Not related to this topic, we booked this several months ago. I'm sure there'll be a little bit, but really talking about Chicago's economy and what to expect and what we're looking for. We'll be discussing challenges it's facing and how the Greater Chicagoland Economic Partnership that was just formed across the counties is working to drive regional economic strategy versus just Chicago alone. It'll be really interesting, so we hope you can join us. Okay, thanks again, everyone. I know you have a ton to get to, so we will let you go. I appreciate your time.
Thank you for having us.